Before we examine the specific risks in non-bank financial institutions, it is worth establishing the scale of the problem that makes this sector so significant. According to Nasdaq Verifin's 2026 Global Financial Crime Report, illicit financial activity has reached $4.4 trillion globally, an increase of $1.3 trillion since 2023, driven by the industrialization of fraud through AI-powered threats and highly coordinated criminal networks. The United Nations Office on Drugs and Crime estimates that between 2 and 5% of global GDP needs to be laundered each year, equivalent to between $800 billion and $2 trillion. To put that in context, 5% of global GDP today is roughly equal to the entire annual GDP of Germany. These are not abstract figures. They represent the scale of criminal proceeds that are actively seeking entry into the financial system, and non-bank financial institutions have become a primary point of vulnerability. Payment service providers, money service businesses, e-commerce platforms, insurance companies, and crypto asset service providers all sit in the path of those funds. Regulators around the world have assessed that this sector presents an elevated risk from money laundering and terrorist financing. That assessment has direct compliance implications. If you are dealing with a non-bank financial institution, your due diligence, your controls, and your monitoring must match that elevated risk. This lesson covers every non-bank financial institution category tested in the CAMS examination, with the red flags, typologies, and exam technique points that the ACAMS instructors flag as near certain question territory. Payment service providers, commonly referred to as PSPs, are a broad category of regulated firms that sit in the chain of initiating, moving, holding, or settling money. They are integral to modern e-commerce and the global flow of digital payments. The category is wide. It includes payment aggregators, payment processors, mobile wallet providers, payment collectors, and a range of other service types. The diversity of the PSP category matters for AML purposes because different PSP types have very different visibility over customer transactions. A payment processor may handle millions of transactions without knowing anything meaningful about the end customer. A payment aggregator may know its sub-merchants but not the customers of those sub-merchants. This gap in visibility, no single institution having the full picture of what is flowing through the payment chain, is the primary reason regulators around the world have designated the PSP sector as presenting an elevated risk. The compliance implication is direct. When you are dealing with a PSP as a customer or counterparty, that elevated risk designation means your due diligence must be correspondingly more intensive. Not standard CDD applied to a standard customer. Beyond the visibility gap, PSPs face a range of specific operational risks that directly translate into AML exposure. Chargebacks and fraud are among the most significant. PSPs typically sit between the merchant and the acquiring bank, which means that when a chargeback is upheld, when a customer disputes a transaction, the PSP is often required to return the funds to the issuer even if the merchant cannot or will not repay. First-party fraud, where a cardholder disputes a legitimate transaction, is a persistent and growing problem. Issuers frequently side with cardholders because of strict consumer protection rules, which means fraudulent chargebacks are often successful. Data breaches represent a separate but equally significant risk. In 2024, a company called Slim CD, based in Florida, experienced a breach that compromised the personal and credit card information of approximately 1.7 million individuals. Unauthorized access to their systems had persisted for nearly a year before the breach was discovered. Multiple class action lawsuits followed. This case illustrates why data security is not separable from AML compliance. Compromised customer data enables identity fraud, synthetic identity creation, and account takeover, all of which are directly relevant to money laundering risk. Partnership risk completes the picture. PSPs are often reliant on third parties to conduct due diligence on their behalf. If that third-party due diligence is flawed, the PSP inherits the exposure. A PSP that assumes due diligence has been done without verifying that it has been done properly is operating with a material gap in its control framework. In AML, material control gaps are regulatory findings. Money service businesses, MSBs, are a related but distinct category from PSPs. Both are non-bank financial institutions. Both carry elevated ML risk designations from most regulators. But they serve different functions and face different regulatory environments. MSBs offer currency exchange, money transfers, money orders, stored value products, prepaid cards, and bill payment services. They are typically regulated, but not necessarily by the same regulator as banks, and not necessarily with the same intensity. In the United Kingdom, for example, the Financial Conduct Authority regulates banks, but money service businesses are regulated by His Majesty's Revenue and Customs. This difference in regulator means there can be differences in enforcement approach, interpretation of obligations, and supervisory intensity. The customer base of MSBs creates a specific and important risk dynamic. MSBs frequently serve unbanked or underbanked populations. Individuals who lack significant formal financial history, who may rely on cash and the gig economy, and who have limited access to traditional banking services. This is not inherently suspicious. But it does mean that MSBs operate with a customer profile that is structurally harder to verify in a transaction environment where cash is more prevalent than in standard banking. Those two factors, harder to verify customers and cash-dominant transactions, are precisely the combination that creates elevated ML risk. MSBs must comply with AML regulations. They are required to establish compliance programs and carry out customer due diligence. But the quality of those programs varies enormously across the sector. Hawala is a critical concept in the CAMS curriculum. It's a trust-based value transfer system operating outside formal banking. Here's how it works: a sender gives local currency to a broker, or hawaladar. This broker contacts a counterpart in the destination country to pay the recipient. A code is used to authorize the payment from the second broker's own funds. No physical money crosses borders, and no SWIFT message or bank record is created. This makes Hawala vital for reaching remote areas, but also creates AML challenges. The primary risk is at the settlement stage, where brokers balance positions through trade-based mechanisms. While not inherently criminal, Hawala is highly exploitable. Structuring and smurfing are among the most important typologies in the entire CAMS examination. And the ACAMS instructors flag structuring as a near-certain topic in the exam. You will almost certainly face a question on it. Know the mechanics precisely. Structuring is the deliberate breaking up of transactions into smaller amounts specifically to avoid triggering reporting thresholds. In the United States, for example, financial institutions are required to file a currency transaction report, a CTR, for cash transactions exceeding $10,000 in a single business day. A money launderer who has $50,000 in criminal proceeds does not deposit it all at once. Instead, $9,800 on Monday, $9,500 on Tuesday, $5,000 on Wednesday. This is structuring. The amounts are calculated to stay below the threshold. The intent is to avoid the reporting mechanism. Structuring is illegal, not just suspicious. In most jurisdictions, the act of structuring is itself a criminal offense, separate from the underlying crime. Smurfing is a variant of structuring that uses multiple individuals, sometimes called smurfs, to make deposits across multiple accounts. Multiple branches, or multiple institutions, further fragmenting the pattern and making it harder to identify. Both typologies are most commonly associated with the placement stage, the point at which criminal cash is being introduced into the financial system. The detection mechanism is pattern recognition, repeated deposits just below the threshold, at regular intervals, at the same or different locations. Two detection tools are particularly important when monitoring MSBs for money laundering: comparative and network analysis. The first is comparative analysis against industry norms. If an MSB typically generates a specific volume, a customer transacting at multiples above that norm should attract scrutiny. This isn't inherently suspicious, but it requires a credible, documented explanation that is testable against revenues and premises. The second tool is network analysis. It tracks customers visiting different branches over consecutive days. This geographic fragmentation is a red flag, suggesting a deliberate attempt to avoid detection at the branch level. Both approaches complement standard alert frameworks by revealing patterns across time and geography. These essential tools are a core focus of the CAMS examination. E-commerce platforms, Amazon Marketplace, eBay, Alibaba, and their equivalents, present money laundering risks that differ from traditional financial institutions in important ways. Their business model diversity matters: business to consumer, business to business, consumer to consumer, and direct-to-consumer platforms each carry different risk profiles. A consumer-to-consumer platform where private individuals sell goods to each other has different vulnerabilities from a wholesale B2B marketplace. Micro-laundering is one of the most distinctive e-commerce typologies. The money launderer uses a large number of very small transactions, individually unremarkable, collectively significant, to move criminal proceeds through the platform. Each individual transaction flies below any alert threshold. The pattern is only visible in aggregate. Mischaracterization of goods is a second key typology. Goods are listed, sold, and shipped, but the description or price does not reflect the actual goods. Overinflated prices on low-value items, or undervalued listings for high-value goods, can be used to move value across borders under the cover of a legitimate e-commerce transaction. Commingling is the third typology, and it is the same principle that operates in any cash-intensive business. A seller on a marketplace platform mixes criminal proceeds with genuine sales revenue. The criminal funds appear as legitimate sales income. The blending makes the illicit flows indistinguishable from genuine commercial activity. This is the digital equivalent of the barber shop or car wash: genuine footfall, genuine sales, but with criminal proceeds commingled throughout. Red flags in e-commerce: prices significantly above or below market value, large volumes of identical transactions that do not reflect typical consumer behavior, third-party payments unrelated to the seller, and goods that do not match their descriptions. When the commercial picture does not make sense, that is the signal to investigate. When the commercial picture does not make sense, that is the signal to investigate. Insurance products are traditionally regarded as lower risk than banking, primarily because of liquidity. Cashing out takes time, involves penalties, and creates a documented paper trail. However, insurance is used in money laundering, primarily at the integration stage, and the CAMS exam will test this. The key red flags to know are: early policy termination for clean surrender proceeds, irregular premium payments, deliberate overpayment to generate a refund, and third-party premium payments where someone other than the policyholder is paying. Know all four for the examination. The Brillante Virtuoso case involved an oil tanker owner who staged a pirate attack to trigger a $77 million insurance claim. Courts found the fire was deliberately set by paid operatives. This confirms maritime insurance as a serious and underappreciated AML risk involving organized crime. The crypto-asset ecosystem is one of the most rapidly evolving areas in the CAMS curriculum, and for the examination, you do not need to become a technical expert. What you need is a clear understanding of the ecosystem structure, the key concepts, and the specific ML vulnerabilities. The ecosystem contains several distinct elements. Blockchains provide the infrastructure for decentralized applications and transactions. Decentralized finance, DeFi, protocols remove the traditional financial intermediary from financial service transactions. Miners verify transactions by solving complex mathematical equations. Each block of transactions is sealed with a unique cryptographic code called a hash, making the record extremely difficult to alter. Nodes are computers that access the network from different locations and collectively maintain the integrity of the ledger. Virtual Asset Service Providers, VASPs, are the regulated entities in the crypto ecosystem, digital wallet providers and cryptocurrency exchanges that allow users to hold, send, and trade crypto assets. The fundamental difference between a blockchain and a traditional centralized ledger is that blockchain is distributed. Every participant can download a copy of the entire ledger. It is also immutable in practice. To alter a record, you would need to control 51% of the nodes on the network, which is practically impossible at scale. The combination of transparency, all transactions are visible on the chain, and pseudo-anonymity, wallet addresses are visible but not automatically linked to identities, is what creates the distinctive AML challenge of crypto. Three specific elements of the crypto-asset ecosystem carry the most significant ML risk and are most directly tested in the CAMS examination: stablecoins, privacy coins, and mixing and tumbling services. Stablecoins are cryptoassets pegged to a traditional asset, most commonly the US dollar. Specifically to reduce the price volatility that characterizes most cryptocurrencies. A criminal holding $10 million in Bitcoin could see that value drop to $7 million the next day. No serious criminal network wants that level of volatility in their laundering operation. Stablecoins eliminate that volatility. They are much more attractive now. They have become significantly more attractive to criminal and terrorist networks precisely for this reason. And there are documented cases of criminal organizations using stablecoins at scale in their laundering operations. Privacy coins take the pseudo-anonymity of standard crypto and make it absolute. Coins such as Monero and Scash are designed with anonymity as a core feature. They anonymize the transaction data, the timestamp, and the wallet identifiers at source. This makes them extremely difficult to trace through conventional blockchain analysis. Standard Bitcoin transactions offer pseudo-anonymity, the wallet address is visible. And with intelligence work, identities can sometimes be established. Privacy coins offer true anonymity by design. Mixing and tumbling services take the layering concept from traditional ML and apply it to cryptocurrency. Multiple users' funds are pooled together, scrambled across many wallets, and redistributed, making the original source of any individual payment extremely difficult to trace. The on-ramp and off-ramp problem is the central vulnerability of the crypto ML ecosystem. And it is where law enforcement, blockchain analytics firms, and AML compliance teams focus their detection efforts. On-ramp refers to the point at which fiat currency, traditional money, is converted into cryptocurrency. A criminal with cash from drug trafficking must convert that cash into crypto before they can use the crypto ecosystem for laundering. That conversion point is a vulnerability. It typically requires interaction with a VASP, which has AML obligations. Or with an informal cash for crypto exchange that may be operating outside regulatory oversight. Off-ramp refers to the point at which cryptocurrency is converted back into fiat currency. At some stage, the criminal wants to spend or invest the proceeds of the laundering, and to do that, they typically need conventional money. That conversion back to fiat is a second vulnerability and detection opportunity. Both on and off ramps require access to the regulated system. Which is why VASPs, virtual asset service providers, are subject to AML obligations in most major jurisdictions. The travel rule, which we covered in the EU regulatory framework, applies to VASPs in the EU and in many other jurisdictions, requiring that originator and beneficiary information travels with crypto transfers above certain thresholds. Blockchain analytics firms assist law enforcement and compliance teams by tracing wallet-to-wallet transactions, identifying known criminal wallets, and mapping the flows between privacy coin transactions and mainstream crypto. Before closing this lesson, 2 points deserve explicit attention, one about a structural risk in private banking, and one about how to approach the CAMS examination itself. In private banking and wealth management, fee structures based on assets under management create a specific and testable conflict of interest. When a relationship manager is compensated based on how much client wealth they bring and retain under management, that incentive structure creates pressure. Sometimes subtle, sometimes explicit, to avoid asking challenging questions of clients. A client who is made uncomfortable by source of funds questions may take their assets elsewhere. That commercial pressure is a real AML risk. It does not mean private bankers are corrupt. It means the incentive structure must be managed with explicit governance. Robust policies, performance evaluations that reward compliance quality, not just AUM growth, and a culture where the compliance function has genuine authority to override commercial decisions. On exam technique, the ACAMS instructors are explicit on 2 points that appear repeatedly in the examination. First, the correct first step when you identify suspicious activity is almost never to immediately file SAR or immediately contact law enforcement. It is to gather more information, review the customer profile, and build the picture sufficiently that the SAR you eventually file is useful intelligence. Second, eliminate answer choices that use absolutes. Cease all transactions, assume the activity is fine and take no action, Inform the customer about your concerns. All of these are traps. None of them is ever the correct answer.